Running Shoes has 2 million shares of stock outstanding. The stock currently sells for $12.50 per share. The firm's debt is publicly traded, was recently quoted at 90% of face value. It has a total face value of $10 million, and it is currently priced to yield 8%. The risk-free rate is 2%, and the market risk premium is 8%. You've estimated that the firm has a beta of 1.2, and the corporate tax rate is 40%. So what's the weighted average cost of capital for Running Shoes? Well, let's go over some of these formulas. First, the required return on the stock market is given by R sub M. And the market risk premium is the risk premium for the market. And we calculate that by taking the risk of the market less the risk-free rate of the market. Okay, we call that the market risk premium. Now, the risk premium for a specific stock I would be the market rate minus the risk premium rate times the beta for that stock. So another way of showing that is just the risk premium of the market times the beta. And then we get to the security market line, which we are representing by the rate of an individual stock, R sub I. And we calculate that by taking the risk-free rate plus the market risk premium times the beta. Okay, so we see that on the right. Risk-free plus the risk premium for that of the market times the beta. Okay, so with that, we can solve this. Now, I've worked this ahead of time. I'll just bring this to light here. Let's change this color to black. Okay, so first, what did I do? I took the 10 million total face value times the 90% recent quote to come up with the current value of the debt. Okay, so we've got 9 million is the current value of the debt. Then we have to calculate the rate. Now I'm going to hit the F2. Again, this is just Excel. You can look up here to see it or down here. Okay, what do they tell us? Where's our debt? The risk-free rate. Wait a second. Where is it? Here it is. It has a total face value of 10 million. It's currently priced to yield 8%. There's our 8%. Now remember, debt is tax deductible. So we've got to multiply it times 1 minus the tax rate. When we do that, we get 4.8%. Now all we have to do is multiply. Multiply the value times the rate and determine the cost of capital of the debt. Okay, so that's the dollar amount of the cost of capital. That's, if you will, what it's costing us in dollars to have 9 million of current value outstanding. Then we move over to equity. With equity, we've got a stock that's selling at $12.50 per share, and there's 2 million shares. If I multiply that across, the current value is 25 million. By the way, I think it'd be better if I underline this and center that a little bit easier to see. Okay, now what's the rate? Well, we're going to work through the security market line. We're going to take the 2% risk-free rate plus the market risk premium times the beta. And when we do that, we're able to calculate what the proper rate is, the expected rate, or if you will, the cost of capital for the equity. Now when we multiply it across, just to get the dollar value, it's costing us 2.9 million out of 25 million of current value. And then we can sum, because now we need to compute a weighted average. So I'm just going to sum from above the values and sum from above the cost of capital. And now the answer is going to be right in this cell when I compute the weighted average. I'll take the total cost of capital given in cell, let me point to it here, given in cell E17, and I'm going to divide that by that cell. Right now, it's already out there, so let me turn this so you can see it. Okay, E17 divided by C17. So the total cost of capital, what am I doing? I'm dividing. And we come up with 9.8. I'm going to make that in bold because that's the answer we're looking for. The weighted average cost of capital for this problem is 9.8%.